This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Skittish markets, stocks fall and took another leg lower midday after a mass shooting in Southern California. Breaking $40, oil prices settle below that key level for the first time since August. On track, Federal Reserve Chair Janet Yellen making her clearest signal yet that a rise in rates may be just 2 weeks away. All that and more tonight on Nightly Business Report for Wednesday, December 2nd. Good evening, everyone. I'm Tyler Matheson. Sue Herrera is on assignment tonight. Well, the day began routinely enough. Some economic news, a speech by Federal Reserve Chair Janet Yellen, and the release of the so-called Beige book. That's the Fed's periodic report on regional economic conditions. Markets rocked and rolled, mostly lower, with oil tipping below $40 for the first time since summer. But then, at midday, came news of yet another mass shooting in America. This one occurred at a center for people with disabilities in San Bernardino, California. As of this evening, authorities say at least 14 are dead. An equal number are wounded. Police are searching for up to 3 suspects who apparently fled the scene and whose motives are unknown. Investors already on edge after the Paris attacks sold stocks into the close. On the day, the Dow Jones Industrial Average fell 158 points to 17,729. The Nasdaq slipped 33 points, and the S&P 500 was 23 points lower. But before this afternoon's events, the market's eyes, as we mentioned a moment ago, were trained largely on Federal Reserve Chair Janet Yellen. She spoke to the Economic Club of Washington and made it clear she thinks the economy is improving. But is it strong enough to raise interest rates 2 weeks from today for the first time in 9 years? Steve Leisman reports.
Thank you. Fed Chair Janet Yellen making generally positive economic comments in a major speech in Washington, pointing the way to a potential rate hike at the Fed's meeting later this month. Yellen signaled a rate hike more through expressing confidence in the economy than saying outright that rates would go up. She cautioned that the data between now and the next Fed meeting, which is December 15th, could change the outcome. The data includes, most importantly, Friday's big jobs report. But Yellen was clear. The Fed's goal has been met on jobs, and she's confident will be met on inflation.
I anticipate continued economic growth at a moderate pace that will be sufficient to generate additional increases in employment, further reductions in the remaining margins of labor market slack, and a rise in inflation to our 2% objective.
The Fed chair acknowledged the dangers of hiking rates too early, but she was much more specific and pointed about the dangers of hiking too late. She warned that the Fed risked abrupt rate hikes if they waited too long, and that could cause recession. New economic data added to the case for the Fed hikes. The Fed's Beige book suggested a bit more wage pressure in the economy. The payroll company ADP reported growth of 217,000 in the private sector in November, more than Wall Street expected. It pointed the way to a robust Friday jobs report from the government of at least 200,000. And Atlanta Fed President Dennis Lockhart said in a speech, quote, "The case for liftoff is compelling." San Francisco Fed President John Williams chimed in. He prefers to hike rates sooner rather than later. The big issues for Yellen and the Fed are the recent downturn in manufacturing and the surge in the dollar. That could further reduce inflation. But we may already be in a world where incoming data, if it's weak or strong, is processed by the market in terms of when the second rate hike will come, not the first. For Nightly Business Report, I'm Steve Leisman.
Let's turn now to Michael Farr for more analysis on the Fed and the stock market's interpretation of what Chair Yellen said today. Mr. Farr is the president of the money management firm Farr, Miller & Washington. Michael, always great to see you. You were in the room today where the speech was given. Did you hear anything? I sure didn't. That would dispel the notion that the Fed is ready for liftoff in 2 weeks?
Well, Chairman Yellen gave herself an out. She also said that they would be data dependent and they would review the data right up until the moment that they meet. So she left that door open, I guess, as any good Fed chairman would. At our table and at other tables, people were checking the stock market before she began speaking to see where we'd end up after the speech. A lot of her notes were released just before, actually, she started speaking. Her text became public. The stock market actually rallied as that text was released and as she started speaking. But by the time the Beige book came out later, it ended up lower. She was clear that what she didn't want to do was see any sort of abrupt hike if they wait too long. And I think that was the important point that Steve Leisman just made. The markets never like to be surprised. It looks really clear, I think, that the Fed's intent on a liftoff here at this December meeting.
She also said, don't pay too much attention to the timing of liftoff. Basically, pay more attention to the trajectory and the pace of subsequent rate hikes. And on that point, she was very careful in the Q&A session with Mr. Rubenstein to say, don't expect that we're going to be locked into the idea of raising rates at every subsequent meeting through 2016.
I thought she was even more clear than that, Tyler. I think that she was clear that this didn't really mean that they were going to have a change in policy. She talked a lot about the neutral rate of borrowing and interest rates for the Fed, and they're really close to this 0 point where we are now. Historically, that level is around 3.5%. It seems a long way off. So she said it doesn't look like we're going to move off of this even after we raise first time, and there is no calendar event and there is no schedule, and she was pointedly clear that this is not the beginning of a ratchet step up by any measure.
Very quick answer here. Is this all priced into stocks and bonds already?
I think the hike is priced into stocks and bonds already. If they don't hike, I think the markets will react.
All right, Michael, thanks very much. Michael Farr of Farr, Miller and Washington.
Thank you.
Well, the Federal Reserve's regional survey of anecdotal information on business activity, that's the Beige book, confirmed what Chair Janet Yellen said today, that the economy is gaining strength. Hampton Pearson has more on what was inside that tome.
The Federal Reserve's latest snapshot of the economy shows growth at a modest pace this fall. 9 of 12 regional banks report modest or moderate growth from early October through mid-November. The New York region saw growth level off due in part to less tourism spending by foreign travelers. But overall, the economy is driven by higher consumer spending, especially on new automobiles and more home sales and construction. Home sales, in fact, rose in 7 of 12 districts, while new home construction increased in most Fed districts as well. The labor market continues to tighten, but the pressure for higher wages only involves skilled workers. That Beige book report suggests healthy consumer spending is offsetting the manufacturing slowdown due in part to the strong dollar and falling energy prices.
I think today's Beige book basically gave a green light to the Fed. If it wants to hike in December, the data is coming together well enough. The key word in the Beige book was moderate. So they noted moderate gains in consumption and wages and so on. And it was across the whole country in the Beige book.
But Fed watchers caution there's still 2 weeks to go and more data on the way, including Friday's all-important jobs report. But momentum seems to be building for monetary policymakers to raise key short-term interest rates for the first time in nearly a decade. For Nightly Business Report, I'm Hampton Pearson in Washington.
American business productivity was higher in the third quarter than initially reported. The Labor Department says productivity, which measures hourly output per worker, rose at a 2.2% annual rate, not the 1.6% reported last month. Labor costs, which measure the price of labor per single unit of output, also rose at a slightly higher rate than previously stated. Well, oil prices, quite a day there. They broke below $40 a barrel as new government data showed a rise in supply when many had expected inventories to shrink. According to the Energy Information Administration, it is the 10th straight week of stockpile buildups. Domestic crude settled at $39.94. That's its first close below $40 a barrel since August. That drop pressured shares of Dow Components, ExxonMobil, and Chevron. They were the Dow's laggards today. Well, all of that extra oil does have to go somewhere, and an increasing number of companies are making big bets on the growing need for more storage space. And no place is that more evident than in Houston, and that is where we find Morgan Brennan tonight.
Just a few miles away from the Astrodome in Houston will soon sit subterranean salt caverns, able to store enough oil to fill the famed stadium. Fairway Energy Partners is developing these caverns that, starting next year, will hold up to 10 million barrels of crude. According to the company's CEO, Chris Hilgert, demand for the storage space has been brisk.
We're actively leasing the capacity right now in the marketplace. It's being received very favorably. We have a competitive cost advantage that we're trying to exploit as much as we can and offer a much-needed service here.
It's one of several high-profile projects under development in the region at a time when, because the world is awash in oil, storage has been filling up. U.S. commercial crude inventories are above 489 million barrels, the highest for this time of year in 8 decades, meaning 2/3 of all U.S. oil storage is in use. Over half of that, 250 million barrels, is sitting on the Gulf Coast, which hit a record high a few weeks ago. Tanks in Cushing, Oklahoma are again filling up as well. Energy companies and oil traders are storing oil rather than selling it because the futures market is valuing crude at higher prices than the spot market. Experts say all of this inventory is a bearish indicator for prices heading into 2016.
The problem is, as you build all of this storage, even when you finally reach a point where supply-demand is balanced, you have this storage hangover, and we have to see these excess storage levels run down before you can ever see the real rebound in crude prices that people are looking for.
Still, a number of companies see storage as a long-term investment opportunity. For example, Phillips 66 is doubling capacity at its Beaumont, Texas terminal, and Enbridge recently announced a $5 billion plan to build 3 oil terminals of its own that would enable the import and export of more crude and petroleum products. Energy data firm Genscape estimates 19 million barrels of above-ground storage is currently under development in the region, in addition to Fairway's caverns.
Lots of new pipeline infrastructure that's built into the Houston market, and the market has responded as best it can to build surface tankage, although more storage is needed in the Houston market to be able to handle a lot of this new inbound crude.
When Fairway's development comes online next year, it will represent 25% of total crude storage capacity in the Houston area. And since salt caverns are typically the least expensive way to store crude, Fairway expects this project to be profitable even when the energy market eventually recovers and demand for storage once again falls. For Nightly Business Report, I'm Morgan Brennan in Houston, Texas.
Still ahead, the trailblazing tech company that is reportedly considering a sale of its pioneering internet business. Expectations are growing for some big changes at Yahoo. Yahoo shares rose more than 5% on reports that Yahoo's board is right now considering selling off the company's core internet business, as well as a spinoff of its stake in Alibaba. Victor Anthony, senior internet analyst with Axiom Capital Management, joins us now to discuss whether or not this could be the right fix for Yahoo. Victor, let's start right there. Should this company basically break itself apart, monetize Alibaba, sell its internet operations, and what's left after that? Take it private or what?
The short answer is yes. I think the first thing they need to do is go through with the spinoff of the Alibaba stake. They should go right ahead and do that. I think they plan to do it in January. There's a lot of pushback from investors because there's a potential huge tax liability that could occur if the IRS would choose to challenge it. So there's some pushback on that. But I think I've spoken to multiple different tax experts, and they think ultimately Yahoo will be fine along those lines. So first thing, spin off the Alibaba shares. I think the next thing is to monetize Yahoo Japan. They own about 35% stake Yahoo Japan. It's a roughly $4 billion asset after tax. If they could save for another $4 billion, you're looking at $8 billion of value there. Then I think what they could do is really offload their search business to Google. And I think they could get a roughly 10-50% lift to the EBITDA if they were to do that. Then after all that's said and done,
what's left?
Well, the core business of display and search, I think it's valued at around $5 billion or so, $5-6 billion. You know, they could potentially sell that. And I think that's an ultimate exit strategy, I think, for Marissa Mayer, is to ultimately, after she's done all these things I talked about, just sell the business.
Is Marissa Mayer the problem? I mean, that company has had lots of reasonably capable CEOs in a relatively short period of time. And I guess it sort of begs the question, could anybody have fixed Yahoo?
It's a great question. It's one I've pondered over several years because they've had multiple different CEOs. I think roughly 5 or so since I've been covering the company over the past several years, and no one has been successful. These are highly capable, highly intelligent CEOs with a long track record of success. They come to Yahoo and they fall flat. So I don't think it's the CEOs. I think she may have probably not been as aggressive enough in making some really big bets. So has her predecessors as well. But I think the core business is really just challenged from a secular perspective. They're facing a lot of competition from Facebook, a lot of competition from Google. It's really difficult for them, I think, to monetize that platform in the way that shareholders will demand.
Very, very hard to understand exactly what Yahoo stands for in an environment where a lot of those companies have really strong platforms in individual areas. Anyhow, maybe it's boohoo for Yahoo. Victor Anthony, thanks very much. Victor is with Axiom Capital Management. Well, CSX cuts its earnings outlook, and that is where we begin tonight's market focus. The railroad company expects profits to grow, but not by as much as originally estimated. This comes as coal volumes have fallen more than expected, and cheap natural gas prices exacerbate that. Shares tumbled nearly 4% to $27.53. The hunting and fishing store chain Cabela's says it is weighing strategic alternatives. This could mean a sale or breakup of the company because of declining sales. The announcement comes more than a month after the hedge fund Elliott Management disclosed it has a stake in Cabela's. Shares rose 2% to $47.89. Brown-Forman reported results that missed estimates. The maker of Jack Daniels, among other spirits, said the strong dollar and invigorated competition weighed on its results. Shares off nearly 2% to $102.06. And Zafgen saw its shares tumble on news a second patient died in a late-stage trial of its experimental obesity treatment. The firm says the patient suffered a blockage in an artery. Shares of this small-cap company fell 60% to $6.28. And On-Deck Capital was higher on news it has partnered up with J.P. Morgan Chase. The big bank said it would use the online small business lenders platform for small business customers. On-Deck, also a small cap, was 27% higher today to $11.50. Well, the materials sector has been outperforming the broader market so far this quarter, and that falls right in line with what history would suggest. But is the group rising this year for different reasons than in the past, and how does that set up the sector for 2016? Dominic Chu here with a look.
Over the past 10 years, material stocks have been a big focus for investors during the final quarter of the year. So you think everything from industrial gases like oxygen and nitrogen to chemicals to aluminum to gold. And according to data analytics firm Kensho, the fourth quarter has produced average material sector returns of nearly 3%, and it's been a positive trade for the sector 7 of the last 10 times. Now, that story is also playing out again this year to a much larger degree. Since September 30th, the group has already gained around 14%. However, much of that gain comes on the heels of a sharp decline in those stocks in the months leading up to this final quarter of 2015. Some experts think the sector is due for a little bit of a breather at this point.
I think the difficulty for the materials sector comes into play when you start really assessing where we are on an economic basis. We have a rising dollar, and so that's going to constrain part of the overall economy. Now, as the overall economy is constrained, it's going to have an impact on these material companies.
Now, economic growth is key for these types of companies because they make more money when their products get used more during business expansion. So a big part of the future story with materials companies lies in how strong the global economy can really be. Now, the more bullish camp feels as though these stocks will continue to participate in the context of a stock market that's headed higher, broadly speaking.
I think the stock markets can continue to grow on the upside. And I think my 3 main reasons of why is that you have a reasonable PE ratios, you have reasonable price to sales ratios, and you have no euphoria in the marketplace on either the greed side or the fear side. So the market will continue and probably most likely surpass 20,000 on the Dow Jones in the next 18 to 24 months.
So it all comes down to how the economy performs, not just here in America, but globally as well. Material stocks have already been underperformers this year to date, but they're finding some year-end cheer at this point. The question is, will it stay that way into 2016? For Nightly Business Report, I'm Dominic Chu.
Coming up, apartment building mailrooms are bulging with all those packages being ordered online, causing a big headache for landlords and more. Here's what to watch tomorrow. Weekly jobless claims are out. The last read on employment ahead of Friday's big Labor Department jobs report. Fed Chair Janet Yellen will testify in front of the Joint Economic Committee down in Washington. And some more economic data, including factory orders and the ISM non-manufacturing index. Those come out, and that is what to watch on Thursday. Well, Cyber Monday sales topped $3 billion for the first time, that according to Adobe's digital index. That was 16% more than last year and well above expectations. Of those online purchases, a record number were made using mobile devices like smartphones or tablets. Well, with online shopping growing exponentially, so is the number of packages arriving at apartment houses across the country this holiday season. Landlords struggling to handle it all. And some are using high tech, and some are just plain refusing to handle any of it. One thing we know for sure is the problem will only get more acute. Diana Olick looks at the latest solutions.
Barely 2 days after Cyber Monday, retail's little helpers are rolling in. Santa's sleighs got nothing on UPS and FedEx this year. And apartment landlords like Monogram Residential Trust are struggling under the weight of it all.
In our portfolio, which is 11,000 units in operation right now and 4,000 under development, we have this year estimated 300,000 packages coming in. It's become a real challenge for the industry over the last several years.
So Monogram turned to tech, installing iPad-controlled lockers in some of its buildings. Package carriers access them directly, no more mailroom.
It's a very easy search system. They find the name, we take a picture of the label, so we have a record of that. We save the label and we choose a package locker size. And we put it in, and then the resident gets an email or a text message.
Tenants retrieve their packages as a security camera watches. The system can cost over $30,000 to install, but in high-end buildings...
For our particular demographic, it's absolutely a requirement.
But other landlords claim this won't be able to handle the surging supply, especially in larger buildings. That's why one major REIT, Camden Property Trust, simply said no to packages in the mailroom. Managing this glut, they said, was costing them more than $3 million a year.
Productivity, it was absolutely part of the equation, but it really came down to more about allowing our employees to service our residents and take care of our real estate, which is the business that we're in.
Camden Property Trust has 59,000 apartment units spanning 10 states and the District of Columbia. Last March, they rolled out the no package policy, which was not popular with tenants.
We've had a few residents tell us they plan not to renew their lease, but again, anytime you make a change to any kind of policy, you run the risk that you do upset some residents.
Camden does allow couriers to deliver to tenants' doors and leave packages there. They claim 75% of tenants have opted to do that, and more than 100,000 packages have already arrived that way.
It doesn't bother me because one thing about it, we have a lot of security here. They've left things, I've seen things on by people's door for weeks.
Safer by elevator, perhaps, than by sleigh. For Nightly Business Report, I'm Diana Olick in Alexandria, Virginia.
And to read more about how apartments are handling the crush of packages, head to our website. That's nbr.com. And that, folks, is Nightly Business Report for tonight. Thanks for joining us. I'm Tyler Matheson, and we want to remind you that this is the time of year your public television seeks your support. We hope you'll give generously. And we thank you for your support, and we'll see you back here tomorrow night.